Interesting note coming in from Mahesh Nandurkar of Jefferies. He states that they have gone ahead and cut the GDP growth forecast for FY22 by close to around 4 percentage points to factor in the impact of the COVID second wave. But having said that, he does not see too much of a fiscal risk. There are no worries on the fiscal front, and in fact there is some amount of room more to stimulate the overall economy. He states that the FY21 tax collections are 6.6 higher than the budgeted, implying that the required tax growth for FY22 is only 9.5%, which is much lower than the nominal GDP growth rate, and hence that seems to be fairly achievable. And not just that, if you look at the recent FY21 fiscal deficit data, it was lower than budgeted, and that was primarily on account of better tax collections. In fact, continuing, Mahesh Nandurkar states that continued high fuel tax upfronting of food subsidy leaves room for close to around $10 billion worth of stimulus headroom, and which is a very important point. He states that he does not expect that there is no change in his expectation on the yield front. They do see a gradual increase in the 10-year G-SAP yield towards 6.5 by December of 2021. Also, speaking more about the fiscal deficit target, which is achievable according to Jefferies, they state that strong recent performance, conservative budgeting implies that there was some room for a likely second wave. Government's tax revenues imply growth of 9.5%, which should be achievable given the likely 13% odd nominal GDP growth rate. An important discretionary source of revenue, which is close to around 3 trillion rupees, which is auto fuel duties, haven't seen any cuts so far, which further establish fiscal credentials. The limited welfare funding announced so far for the second wave is manageable, and considering the over-provision of subsidies in FY21, Jefferies believes an additional 0.5 lakh crore headroom exists there. He also speaks about the government may see a shortfall on the non-tax revenue front despite the rupees 500 billion higher than budgeted RBI dividend, as the rupees 1.75 lakh crore divestment target will be tough to achieve. However, considering the conservative provisioning in tax estimates, nearly around 0.5 lakh crore of revenue headroom is likely available. He also states that the government's decision to borrow rupees 1.5 lakh crore for the purpose of GST revenue shortfall would take up the gross borrowing for FY22 to close to around 13.6 lakh crore, which is similar to FY21 levels itself. In fact, he states that there is no change in terms of the 10-year yield or expectation rising to nearly around 6.5%. And he also mentions that given the focus of 10-year and no fiscal slippage yet, they do not see the upside to their target of 6.5% on the 10-year yield front. Thank you for listening.